Hi everyone. Welcome to today's episode. Today, we're diving into one of the most legendary financial battles in history, a battle that shook the global currency markets and made one man a household name. That man is George Soros. In 1992, Soros made a bold move through his quantum fund that earned him a staggering $1 billion in just one day. This incredible victory earned him the title, the man who broke the Bank of England. But how did he pull it off? And what financial genius and strategic insight lay behind this legendary trade? Today, we'll unravel the thrilling story behind this epic financial showdown and explore the business wisdom hidden within it. Our story begins in the late 1980s in Europe. At that time, European nations were moving toward economic integration, and in 1990, the UK joined the European Exchange Rate Mechanism, or ERM. The ERM required the British pound to maintain a fixed exchange rate against the German Deutschmark, with only minor fluctuations allowed. At first glance, this seemed like a good idea. A stable exchange rate would promote international trade and economic stability. But beneath the surface, a major problem was brewing. In the early 1990s, Germany's economy was booming, and inflationary pressures were mounting. In response, the Bundesbank, Germany's central bank, raised interest rates. Meanwhile, the UK was in a recession, high unemployment, low consumer spending, and a struggling economy. To recover, the UK needed low interest rates to stimulate growth. However, to maintain the fixed exchange rate under the ERM, the UK was forced to keep interest rates high, which made its recession even worse. This policy contradiction made the British pound vulnerable, and market players began to doubt whether the UK could maintain the fixed exchange rate. And this was where George Soros saw his opportunity. Soros was known for his sharp insight into macroeconomic trends and policy contradictions. He realized that the Bank of England faced a no-win situation. To defend the pound, they would need to spend massive amounts of foreign currency reserves to buy pounds in the market while maintaining high interest rates. But in a weakening economy, this strategy was unsustainable. Seeing this, Soros made his move. Through the quantum fund, he began short-selling the British pound on a massive scale, while buying the German Deutschmark. His strategy was bold but simple. He was betting that the Bank of England would eventually give in, causing the pound to plummet. And then came the fateful day, September the 16th, 1992, now known as Black Wednesday. The Bank of England tried desperately to defend the pound, spending billions in foreign reserves and announcing significant interest rate hikes. But the market didn't buy it. Traders followed Soros' lead and dumped the pound, driving its value down even further. By the end of the day, the Bank of England surrendered. They announced that the UK would withdraw from the ERM, and the pound collapsed. Soros' gamble paid off spectacularly. He walked away with a $1 billion profit, while the UK lost over £3 billion in foreign reserves and its reputation for economic stability. This historic event not only made Soros a legend, but also exposed the power of hedge funds and the vulnerability of currency markets. Behind his success were several key business strategies and financial insights. First, mastering macroeconomic analysis. Soros wasn't merely betting on currency fluctuations. He accurately predicted that the UK's economy couldn't handle high interest rates while trying to stimulate growth. He saw the policy contradiction and seized the opportunity to exploit it. Second, leveraging financial power. Soros used borrowed capital to short the pound on an enormous scale. This high-risk, high-reward strategy amplified his gains significantly. Such leveraged bets are a classic hedge fund tactic, but require precise market timing and bold decision-making. Third, understanding market psychology. Soros knew that once doubt crept into the market about the pound's stability, panic selling would follow. His massive short positions triggered a domino effect, creating a self-fulfilling prophecy that ultimately broke the Bank of England's defenses. From a business perspective, this legendary trade offers three key lessons. First, macroeconomic trends shape market movements. Soros' success came from identifying a policy contradiction. The UK couldn't maintain high interest rates and economic growth simultaneously. This insight allowed him to predict a crisis before it unfolded. Second, confidence is more valuable than capital in financial markets. The Bank of England didn't just lose because of a lack of funds. They lost because the market lost faith in their policy. Once confidence was shattered, no amount of money could stabilize the pound. Third, risk management and agility are crucial. Soros maintained a flexible strategy throughout the attack. He was prepared to adjust or exit his position if market conditions changed. This strategic agility was key to the quantum fund's success. George Soros' attack on the British pound wasn't just about making money. It was a calculated play on policy contradictions, economic vulnerabilities, and market sentiment, a masterpiece of strategy and decision-making. As Soros himself once said, "I simply seek out market imbalances and profit from them." His words remind us that in finance and in business, identifying opportunities and acting decisively can lead to extraordinary success. So, what do you think? Did Soros simply seize an opportunity, or did he push the market to the brink? If you enjoyed this story and want more business legends and financial insights, don't forget to like, subscribe, and drop a comment below. Thanks for watching, and I'll see you in the next episode.